Mine right. So we started recording now. So if this goes well, there will be recording. So if there's some good stuff in here that you want to listen to later, hopefully it works out for that. But first of all, I want to thank everybody for taking time out of their day to meet here, either in person or online. It shows you put a lot of value on not overpaying your taxes. But unless you're here just because you love to learn about taxes, we're always looking for new talent, so you can leave an application at the door. So we're here to talk about the Tax Cuts and Jobs Act of 2017. It was a true tax reform. What we've had in the past 31 years have been tweaks to the tax law, but what we have here is true tax reform. Although on the individual side, it's still a little bit of tweaks and the true reforms on the business side, so that's why this is an exclusive for business owners, because that's where all the changes came through. And my goal here today is to give you that 30,000-foot view of the changes at that base level of knowledge that what we're going to be working towards and working against. So the first mistake that I see clients and other taxpayers make is just a failing to make a plan. When you just file a tax return or you're recording history, and at that point there's limited opportunity to reduce your tax. So we're playing with a whole lot of new rules, and setting up yourself for success under the new rules is going to be critical. And there's also a misconception of that the tax law is just a bunch of rules that ruins a lot of fun, which the taxes were generated to create revenue for the government. I understand that. And but you need to understand that only a small portion of the tax code is actually dedicated to generating revenue for the government. The rest is dedicated to reducing your taxes. So I know that sounds crazy, but hear me out here. So the beginning of the tax code is dedicated to gross income and defining what is taxable, and that is basically any money you receive. After that, there's the charts to quantify how much is taxable, or how much of that is taxed. And then, so we're talking, maybe 100 pages of this 6,000-page tax code. The whole rest is dedicated to exemptions, exceptions, deductions, opportunities to reduce your tax. And Congress created all these new rules that are really new incentives and just changing your facts to match these incentives to reduce your tax. So having that mindset going in that there is opportunity to reduce your tax is what's important here and why the plan is critical. So I did say this isn't a business-focused presentation, but most of you own pass-through entities, and because you have pass-through entities, that means you're taxed at your individual tax rate. So understanding some of these individual tax changes is actually really important for going forward. So this chart here I have on the screen. For those online, I am on the third slide now. It's a chart made by Michael Kitsis. He's a blogger in the financial planning world, and he showed a nice comparison here of the old tax rates and the new tax rates. So everything here in the green is a tax cut. So there's a lot in the married filing jointly section, not as much in the single, but overall you can see there's more green than there is red. So overall there's just inherent tax savings that most taxpayers are going to experience just from the tax rates alone. But we need to understand tax rates through history and kind of put this into perspective. So on the next slide, we have the tax rates through history, and as you can see, tax rates have been significantly higher, and then specifically after wars, they had to increase the tax rates to increase revenue. So that's the purpose of taxes. And the question is, are we in an artificially low tax rate environment right now? Don't have a crystal ball, but it's something to consider. And one specific tax, in 1935, there was I think it's called tax the rich, and it was set to take 75% of income over $5 million. It got one person, John D. Rockefeller. So they can change the tax law in ways that accomplishes the goals they need. So understanding that maybe we are in a low tax rate environment is an important consideration at least. In fact, in 2026, we're expecting rates to go back up because there was a tax rates are pushed through tax reconciliation, meaning you can't increase the deficit beyond 10 years. So this, if everybody knows the story of Cinderella, she had till midnight to go out and have fun, and she had to be home by midnight. And if she wasn't home by midnight, her carriage turned back into a pumpkin. So this is our period. This is our pumpkin period, and there's tax rate increases within the next 8 years. So we might be in an opportunity of just a short period of tax rates, good tax rates, low tax rates, with higher ones directly on the horizon. So we're all here to talk about keys to cutting tax. And there's really 4 ways of doing it. And I'm on to the next slide for the online participants. So there's timing, shifting, code, and products. Timing, shifting, and code are all going to come into play heavily to what we talk about today. Products, not as much. Was probably the most focus on the code because tax reform changes the code, so therefore we have to understand how the code works for our benefit. So examples of timing is this: do I buy it this year or next year? Do I accelerate depreciation now, or do I expand it over the long period of time? Shifting is shifting income to a lower tax rate. So that's either you're like a child or a family member or a different entity that's taxed differently. The code is what we're here to talk about. Products, like I said, we're not going to hit on that as much today. So the next slide is the kiddie tax. So this is one area that I wasn't sure where to put it in the slide, but kiddie tax has had an interesting change, and something that's actually been a little underrated for the coverage it's gotten. So in the past, if you shifted unearned income, so interest, dividends, capital gains to your child, they'd be taxed, and it had income over $2,100, we tax at your rate. So say you're in the new tax rate, you're at 33%, your child would pay 33% on that unearned income. So as business owners, we could hire our kids in our business, and that's earned income. That's not the same category. Unearned income is the interest, dividends, and capital gains. Under the new law, they changed the tax bracket for kiddie tax to match trust and estates. So that means after $12,500 of unearned income will be taxed at the maximum rate, which for a lot of middle earning income families that are in here, that actually means your kids' unearned income will be taxed at a higher rate than you. So they're going to hit that 20% capital gain rate. That they'd avoid the 3.8% net investment income tax, you're aware of that. But the point is that 37%, the top tax bracket is right there. So and not that far away. So this may not apply to a lot of us, but it's just an important change that to keep in mind if you do utilize this kind of shifting. But as a reminder, you can hire your kid in your business, and that's not these same brackets. There's still reasons to hire your kid in the business for their lower ordinary brackets. So all the media coverage, not all of it, but a lot of it has been around the standard deduction, loss of itemized deductions. In New York, they had people lined up outside to pay their real estate taxes because they're never going to receive a benefit for it again. Well, some of that they probably weren't getting the benefit anyway because of AMT. So some of that was just they listen to the media and not understand their tax circumstances. But the big change here is that so like single is that on the bottom right-hand corner. The single item standard deduction was at $6,350, and married filing joint was at $12,700. They basically doubled that and put that as our new standard deduction. And what this means is that a lot of us aren't going to itemize anymore. So when they were talking about tax reform, they were talking about postcards, filing your tax return and postcards. Well, this is as close as they could get to doing that. If you're a business owner, you can forget that postcard. Right now, it's over. But for anybody that's just like your employees of your company who have your W-2 and maybe own a house, this is pretty close to filing on a postcard because they're not going to have to worry about itemizing, keeping track of their donations, their mortgage interest, their real estate taxes, etc. And then retirees that have fixed income and own a house, this is where it's going to help them out a lot. And so the next slide, I have a page here that really illustrates the itemized deductions and how those changed. So the big change was the state income tax and real estate taxes. So now that is capped at $10,000. So if you live in the state of Wisconsin, especially in Madison, you have high property taxes and you probably have reasonably high state income taxes. Only $10,000 of that goes into your itemized deduction bucket. Your mortgage interest, that stayed the same. Your gifts to charities, that stayed the same mostly, but now you can actually go up to 60% of your adjusted gross income. But everything on the bottom, your unreimbursed employee expenses, your investment management fees, those are no longer part of the equation for the itemized deduction. So on the left, I did just a little calculation to give a general idea of what does it mean. Will I itemize just to give you a ballpark? And this is all based on your facts and circumstances, but I just want to show you one example. So assuming everybody's state income tax and real estate tax is capped at $10,000, we'll have that $10,000 amount met, but then we need a combination of mortgage interest, charitable donations, and a few other little things that need to exceed that $14,000. So in this example, you need $10,000 in mortgage interest, $3,500 of cash to charity, and your $500 deduct donation to Goodwill. If you're single, it's actually going to be easier to itemize because you still get that same $10,000 cap. So your mortgage interest and your cash and non-cash to charity, that actually is going to not be that, you don't need as much of that to itemize as a single. So this is just to give you a little illustration. And because we're going to lose those benefits, this next slide is changing your facts. So to reduce your tax, you need to change your facts. And people get a little excited when I say that and think I'm talking about legal deductions. No. Legal deductions are, that's called tax evasion, and that's 10 to 20 years, so that's not even relevant. So changing your facts just means, like, with one example is you're going to lose your benefit potentially lose your benefit for your mortgage interest and your real estate taxes. The way to shift that from a personal expense that you don't get any benefit for is to turn it into a business expense. That's where the home office deduction is available. In the past, we said we got benefit for it because we went on Schedule A and I didn't really want to do all the record keeping for it. Didn't want to do the record keeping. I didn't want the CPA to spend time calculating it, so we ignored it. But now it's worth zero. It could be worth $0 versus whatever your tax rate is now, so 0 to 37%. It's pretty easy to say that now, maybe changing your facts, actually not working at the kitchen table, moving into that empty room, and dedicating it to a home office. There's actually some incentives to do that now. The next part is charitable contributions, and there's a lot of concern that charities won't get as much donations because there's not the tax incentive. I don't know how that'll work out. It'll be interesting, but the way you donate to receive benefit for it, just kind of, once again, change your facts. So maybe donating every other year because you bunch your donations. Instead, if you donate to church every week, instead donate it all in 1 year, like 2 years worth. Your favorite charity, donate all in one year to make your facts work so you get the benefit for it. And the donor-advised funds will be probably the most popular method of bunching because what a donor-advised fund is it allows you to contribute a large sum of money, takes an immediate deduction for it, but then you can pay out to your charities over a time period. So say you just won the lottery, something easy. You won $1 million and you want to donate to charity. You could donate $500,000 in 1 year and get the deduction in that year, and then pay that $500,000 off over the course of multiple years. So the donor-advised fund will be a very popular and powerful vehicle to use to bunch those. Charitable trusts will be used more. Those are for those years of sales of a business or a highly appreciated property. And then unreimbursed employee expenses. So most of you don't run into this because you are business owners and you have good record keeping, but if you didn't have the system in place to deduct it on your business and you were relying on this unreimbursed employee expenses, this is where setting up an accountable plan is necessary to get the deduction. So changing your facts to reduce your tax. So the next area is depreciation and expensing. So in real estate specifically, depreciation is king. It is what protects you can have positive cash flow, but a loss on your tax return because depreciation is shielding your cash flow from being taxed. And they made the depreciation expensing more favorable. So now bonus depreciation can be used for new and used assets, and before it was only on new assets. When I say new, I mean brand new, not new to you. So under the new law, you buy anything, you can immediately expense it, 100% of it immediately expense. Section 179, so rental real estate. So when you had anybody that was a rental real estate, you could not use Section 179. Under the new law, you're actually allowed to use Section 179, and it's been expanded to some real property. So you put on a new roof, you put in a new security system, some stuff that was depreciated over the life of your building, 39 years, 27 years, can now be Section 179. So the depreciation just became a lot more favorable, which leads to the idea that cost segregation studies will be very powerful, because cost segregation studies, that's where you buy a new building, you break out all the components over the 5-year components, the 7-year components, the personal property, and now you can use bonus depreciation in Section 179 and immediately expense it. You buy that building, you can't use the 179 on the roof, the original roof, it has to be a new roof. So the depreciation expensing, your depreciation shield just got a lot bigger. So like-kind exchanges, that's the other component. So in a cost segregation study, you can break out the personal property from the real property, so your fixtures and certain wiring at 5- and 7-year property, at 7-year life, and you can immediately expense it. But now the like-kind exchange rules, you cannot like-kind exchange personal property. So if you do this breakout, you actually would have potentially depreciation recapture in the year that you did this like-kind exchange, because you're selling the personal property in the building and exchanging the real property, so you're exchanging the building. So a cost segregation study may not be beneficial if you're not going to keep the property for as long. So you'd have to really run the numbers and say, is this worth it if I'm going to plan on doing a like-kind exchange in a few years. The other part is trading in equipment. The like-kind exchange, if you had a truck or a tractor, something like that, you would trade it in. When you bought a new one, you could do the tax-free like-kind exchange. That's over. You can't do that anymore. There's literally no incentive to do a trade-in other than convenience of the transaction. Because you have to, you trade it in and you trade in this tractor on the screen and you get $20,000 of value for it in a trade-in. You have $20,000 of proceeds on the transaction and have to pick up gains potentially on that transaction. It's no longer just kept inside the, doesn't reduce the basis in the new tractor. So don't trade anything in unless you just want to do it for convenience reasons, because it's a sale now.